Hello guys, and welcome back. In a follow-on video to my recent video on the Fed tapering and how that's going to affect or has been affecting all of the equity markets, I wanted to release a quick video on my thoughts of crypto within an investment portfolio. So, title of the video, should you hold crypto within an investment portfolio? Now, here's an article, I'll link it in the description, which is over on the Nasdaq's website. And it talks about how Bitcoin has vastly outperformed gold and the S&P 500 over the past decade. So if we scroll down, they've got a nice little table here which shows Bitcoin versus traditional assets such as the S&P 500, ETF or fund, and gold. And we can clearly see that the performance of Bitcoin or cryptocurrencies has vastly exceeded the return on investment that you would have seen in the S&P 500 or if you just held gold. Now, skeptical ones amongst you may turn around and say, well, okay, but Bitcoin's incredibly volatile. That's correct. So if we flip over to CoinMarketCap and just have a quick look at Bitcoin, I mean, we can see these moves anyway over the past couple of months. I mean, Bitcoin was trading at £50,000 per coin, and we're now down at sort of 30k. So massive movements, and the volatility you'll see swings of 10 to 15% in a day sometimes. Now that would be normally reserved in the equity market as a crash. For Bitcoin and cryptocurrency, that's almost a typical thing. Now there's no mistake to be made. These cryptocurrencies and the blockchain space and Web 3.0 and the rest of it is all the new kid on the block. This is all new technology, and we are at the very beginning. Bitcoin's market cap, the cryptocurrency market cap in general is a tiny percentage of the amount of money sloshing around within equities. Okay, so let's adjust for risk. Let's adjust for that volatility. So what is a risk-adjusted return? Well, a risk-adjusted return is a calculation of the profit or potential profit from an investment that takes into account the degree of risk. In my previous video, I mentioned that you effectively have a risk-free rate, also known as a treasury bond or an interest rate, and investors are effectively willing to take additional risk to see additional return. There's no point in taking additional risk to see no additional return because you'll just burn through capital. Okay, well, how can we measure risk-adjusted returns? We can do that via the use of something called the Sharpe ratio. Now, there are other variants of this ratio, like the Sortino ratio and other things which help to cover the weaknesses of the Sharpe ratio, but we'll keep it simple. And this was developed by a Nobel Prize winner, William F. Sharpe, and it helps investors understand the return of an investment compared to its risk. And this is used quite a lot to price equities and also to create portfolios. You can see the formula on screen now. Now, here's an interesting chart. I'll link this in the description. If we basically calculate these Sharpe ratios for a bunch of different assets and look at their performance over time, we can clearly see, even if we adjust for those crazy swings in the Bitcoin price, its Sharpe ratio far exceeds, up until recently, where the crash has been exaggerated a little bit, it far exceeds the returns, risk-adjusted returns, that we would have seen from plenty of other assets. So in the blue line here is US stocks or equities. The dark brown line is gold, and then we've got a few others in here, real estate and bonds. So I'm just going to uncheck these, and we'll just look at these sort of three assets of Bitcoin, gold, and US stocks. Let's turn Ethereum on as well. Now, interestingly, what we can start to see here is that Ethereum risk-adjusted return, or the proxy effectively for the altcoin space, is starting to outpace Bitcoin's risk-adjusted return. Now, I'm not a financial advisor, so I can't provide you with financial advice, but it may be well worth considering a small allocation towards cryptocurrencies in your portfolio, just due to the nature that its risk-adjusted returns exceed that of traditional assets. Food for thought. Let me know what your guys' thoughts are in the description below, in the comments below. Take care.